The U.S. Federal Reserve cut interest rates for the third time this year as U.S. economic growth continued to slow. Meanwhile, the Bank of Canada held rates steady and remains the only central bank among the G7 countries not to lower rates. Bank of Canada Governor Stephen Poloz did strike a more dovish tone and warned that the resilience of the Canadian economy will be tested. Here to break down what all of this means, Michael Craig, Head of Asset Allocation at TD Asset Management, and Scott Coburn, he's Managing Director at TD Asset Management. They're going to be joining me for the entire show. It is great to have you both here.
Great to be here.
Great to be here.
Let's start with the central banks. I should mention, of course, Bank of Japan is the next one to come on today.
Tonight?
Yeah, busy day. So basically, the Fed cut again. The Bank of Canada did not cut again. And Bank of Japan will see. But the Bank of Canada was a bit of a surprise here, wasn't it?
Absolutely. I think the market was expecting them to be right steady. And they introduced a notion of dovishness where there is a possibility of a rate cut they put on the table. So the Canadian dollar weakened today and rates rallied a lot more. And so it was a little bit more striking the concern about the global growth and the trade uncertainty. And that really, I think, caught the market a little bit by surprise.
Were you caught by surprise a bit by this?
Look, the Canadian dollar's had a good run here.
Yeah.
I think the CAD's up about 9% versus the euro this year, 4% against the greenback. There's been a lot of optimism in Canada. And so this has just taken some of the air out of that a bit. A lot of this is what's happening outside of our borders, and that's causing. And so I don't think the statement wasn't shocking. I think the market was just not positioned for it, and we saw a pretty massive rally in bonds today. The bond market was up $1, give or take, which is a pretty big move. And the loonie was off significantly, so particularly against the crosses. So late day, the CAD really sold off against euro, yen, sterling, dollar, et cetera.
It's interesting to see with the Canadian dollar too, because I guess you have this tug of war. I mean, high interest rates, our interest rates, are higher, commodity prices low, so those things clashing a little bit.
So first off, we now have the highest interest rates of the G7. We have the tightest, therefore by definition, tightest monetary policy of the G7. So it's an interesting backdrop. So today, while the dollar was weaker today, this should be pretty supportive of the loonie going into the end of the year. I wouldn't be rushing to go sell your Canadian dollars at this point in time. I think likely from this point forward, we'll see a stronger loonie going into the end of the year.
Okay.
Sure.
I think, you put on top of that the potential for fiscal stimulus.
Yeah.
A combination of tight monetary policy or stable monetary policy.
Yeah,
at
and
least.
spending with a new government.
And spending in the new government in the new year. I think that generally is supportive for any currency. And so the backdrop is generally positive for the Canadian dollar.
Yeah, our thought process going into next year is when you think about what's going to happen on the fiscal side, if you start to see investment in infrastructure and things that support productivity alongside, relatively speaking, tight monetary policy, very bullish for the dollar, Canadian dollar going into 2020.
Let's talk about the cross and on the U.S. dollar, then what happened with the Fed today. 3 cuts, it sounds as though, and done. So my question is that enough of an insurance policy in terms of what's happening with the U.S. economy? What did you think of what Mr. Powell had to say today?
So we've had a huge rally in long-term interest rates and short-term interest rates. So you've had this stimulus is going to feed through the economy. So it makes a ton of sense for the Fed to go on pause here, let this feed through into the economy and see as data unfolds. I mean, obviously the big backdrop is always trade and trade uncertainty, but to the extent that moderates a bit here, and with all that stimulus, it's a good thing. Yeah,
and how is the data looking? Because I know the media screams recession. I mean, every time we get something in inverted yield curves, which we talked about, but at the same time, GDP data came out of the States today. I mean, it was a little softer than expected, but consumer was still pretty strong. I mean, there's a lot of stuff there that still sounds pretty good.
Balance, the consumer side of the economy, 70% of the economy is still okay.
Yeah.
It's the concern from trade feeding through into, business confidence, executive confidence, and that is the worry. Does it feed through into the consumer side? And so far, it isn't. And so, the U.S. economy just keeps struggling along. 3 cuts, it's putting a base in things, and to the extent that we get any relief, well, whether it's Brexit or trade, that's a potential for an inflection here.
There's been a little bit of intellectual laziness, I think, with the recession talk. People always look at a flat curve and they say, oh, recession's coming. Look, there's a lot of distortions in the world right now. We've got a tremendous amount of bond buying, both by the Bank of Japan and the ECB, which has distorted interest rates. And so you're looking at an indicator that perhaps historically in the 20th century, yes, we'd be a recession right now, but today's backdrop that's so different than those previous periods, I don't think you can look at a flat curve and say, yes, we're going to have a recession next year. It's just not, it doesn't have the forecasting power I think that it once did.